Well, good day. My name is Kim Moody, and I'm your host for In the Mood with G C Moody podcast. Today is October 8th, and the last couple days have been rather interesting, to say the least, with respect to material that's been released by the Department of Finance. And so today I want to talk about that, and it all goes back to the proposal to separate the budget, the government federal budget, into operating and capital. And when this was first proposed by the Liberal leadership candidate Mark Carney, and of course now he's the Prime Minister, he proposed it in his leadership campaign back in early March, late February of this year, 25. That if he got elected, that they would separate the federal budget into operating and capital. I thought, what the hell is he talking about? And so dug into it a little bit, and I wrote a Financial Post piece on this on March the 4th, and I entitled it, "Carney's accounting trick should not fool anyone that the future will be rosy," because in a nutshell, what he was saying was that he's going to try and balance the operating budget within 3 years so that ultimately they can provide some tax relief, which I thought, all right, that is unbelievably misleading. And so I wrote a piece in the Financial Post on that. It got some pretty decent pickup. And I went back to basic accounting principles. And for anybody that's interested in accounting, the history of double entry accounting, debits and credits. The father of double entry accounting is the Italian mathematician Pacioli, and things need to balance, and that's why we have a balance sheet. And in the government context, it really doesn't matter, as I concluded in this Financial Post piece, about how you account for things, whether it's operating or capital. You still need to finance those things, and so in the government context, it's even worse because you can't get out there and raise money from private investors. You can raise money on the bond market, which ultimately is debt, but the context of equity in a government context is almost non-existent. Well, it is non-existent, and so if you're going to label something operating or capital, you still have to pay for it, and in the government context, it's debt. And so who cares if you balance the operating budget within 3 years, other than the fact that, if you're going to try to reduce waste in the system and you find that your operating expenses are higher, great, that's a good thing to do. But if you're ultimately going to label things capital and put more into that column, then who cares? You're still raising debt. And so this, one of the common phrases that this particular government uses, and it's all the ministers that are, clapping seals on this kind of stuff, which is, we're going to spend less to invest more. That is such a laughable and vacuous phrase. Every time I even say it, I just laugh, because it might fool the financially illiterate, but it certainly doesn't fool sophisticated people. And I put myself into that category, maybe narcissistically, but you're not going to fool me with this one. You're not going to fool the bond markets on this. If you're going to spend less, which ultimately means presumably that you're going to spend less on operating, to invest more and put more into the capital column, really the bottom line is, how much debt are you taking on? That's really all that matters. And so, if you're fooled by that phrase, spend less to invest more, I would challenge you to don't be impressed with it, because it is a nice little political slogan that appeals to the masses who are financially illiterate. And so fast forward to a couple days ago from when I'm recording this today, October 8th, 2025, and we have a Department of Finance release, because of course the open question that I posited in my March 4th Financial Post piece, and a lot of people have including the Parliamentary Budget Officer, has been saying, well, what's going to be your definition of capital? And so the October 6th Department of Finance release that came out provides that definition. But before I read you that definition, let me give to you what the classic definition of capital assets is. And this is in the context of business, and so obviously it's not in the same realm as government, but let me just read to you what a classic definition under GAAP, Generally Accepted Accounting Principles, is. So the classic definition is for capital assets is it's property of a lasting nature that is acquired for use in the production of income or investment rather than for sale in the ordinary course of business. Yeah, that's a good definition. And if you wanted a short one, kind of pragmatic definition, it would be assets that provide lingering value. And lingering typically means more than one accounting cycle, which in plain English is typically a year. So if you're acquiring something like that, and the most typical thing would be land, for example, land or buildings. Yeah, that's going to last more than one accounting cycle, and so that typically is going to be an asset, unless you're a home builder who acquires it for resale. Then no, that's inventory. So you got to be careful with the distinction. Now, let's go to what the definition of capital asset is for government purposes. And there's public sector accounting standards that governments follow, including the federal government. And I'm just going to read to you what the classic definition is here. I just got to pull it up here, so 2 seconds. And it's pretty much the same, but it's modified because governments, of course, are not in business. So under public sector accounting standards, tangible or intangible assets held by government for use in the production or supply of goods or services for administrative purposes or for the development, construction, maintenance, or repair of other tangible capital assets, and that have useful lives extending beyond one fiscal year. Okay, so in short, they're long-term assets used to deliver public services. They're not held for resale or investment. Okay, makes sense. And you can see the obvious distinction between the classic definition that I've already read and the government. Governments are not in the business of reselling. They're in the business of providing services. So it makes sense that if you're going to record assets from a public sector point of view, it needs to meet that definition. It's got to be for the use in the production or supply of goods or services for administrative purposes or for the development, construction, maintenance, or repair of other tangible capital assets and that have useful lives extending beyond one fiscal year. So those are the classic definitions of capital assets. Now, let's go to the October 6th definition that is being proposed under a new capital budgeting framework. This is right out of the October 6th Department of Finance release. So I'm going to read this to you verbatim here. So the new capital budgeting framework establishes a consistent way to classify spending, including tax expenditures. Okay, I'm going to stop there. What is a tax expenditure? Well, if the government puts out a new tax credit, let's say for, one of my favorites, the teacher supply tax credit. I have nothing against teachers, but why are they allowed to claim supplies and get refunds on their tax returns as a tax credit when a lot of other trades are not able to do that, or accountants who need to buy calculators? If they're an employee, they're not able to do that. So it's just really cherry picking stuff like that I don't like. But so the teacher supply tax credit, that is a tax expenditure because it costs the government money in order to give that kind of tax credit. That's essentially what a tax expenditure is. So if they allow childcare deductions, for example, or RSP deductions for contributions, those are classified as tax expenditures. And now, for budget purposes, going back to the definition, they want to include the cost of those tax expenditures as a capital asset. That makes no sense whatsoever. I mean, I'm an accountant by background, and I can tell you that that is a real stretch to say that if it costs the government money by providing a tax expenditure like a tax credit, that somehow that has lingering benefit, going back to the definition of public sector accounting, what a capital asset is. So I have a real problem with that. So let's keep going here. So it says classify spending, including tax expenditures, that contribute to capital formation. Oh, interesting. Contribute to capital formation. That's different than what I read to you on public sector accounting. Referred to here as capital investment, while maintaining pre-existing categories used in budgets and financial reports. Okay, well, financial reports would be public sector accounting that I mentioned. It says drawing on best practices from other advanced economies. Yes, there's other countries that have tried this accounting trick. The UK is one of them, and Greece is another one. And as a matter of fact, the provincial government of Alberta, back in 2013, the Redford, under the short-lived government of Premier Redford, tried this trick as well and got completely roasted and abandoned it. And so I don't really draw a lot of comfort on drawing on best practices from other advanced economies. Yeah, give me a break. And adapted to the Canadian context. Oh, so that gives you some room to maneuver here. It sets out clear standardized criteria to assess whether a given measure qualifies as capital investment. So here's the key. Under this framework, capital investment is defined broadly as any government expense or tax expenditure, there we go again, that contributes to public or private sector capital formation, held directly on the government's balance sheet or on that of a private sector entity, indigenous community, or another level of government. Within this broad definition, the intent is to focus on capital investments that meet the following criteria. And then it goes on to conditionality and clear linkage. But when you read that with a critical eye, like I just did, number one, whoever drafted this is very clever with words. And number two, it's extraordinarily broad. And number three, it's a bunch of meaningless words. But hey, if you want to be impressed by good language, read it. But I challenge you to actually make sense of it. The sense that I've made out of this is the bottom line is it's giving the government it's signaling the government intention that if it wants to classify something for budgeting purposes as capital, it can be. So let me give you an example. Let's say the government decides to hand out more green tax credits, which there's been no shortage of those over the years, or some sort of tax advantage by accelerated depreciation, for example, for carbon capture equipment, for example. That would be considered a tax expenditure. And in this very broad definition of capital for purpose of budgeting, it would more than likely fit. And therefore, whatever it's costing the government, let's say it's $1 billion in order to provide these tax expenditures, which $1 billion is low in the whole scheme of things, but let's just say it's $1 billion, then that would fall within the capital budgeting side of the equation. So what does that do? If the government is actually providing that tax expenditure, and now the government is putting it into the capital column as opposed to overall operating, what does that do? Well, it obfuscates, hope I pronounced that right, but it misleads Canadians into believing that the budget, which they're going to focus on the operating budget, is better. In other words, the deficit is lower than the overall deficit, because normally any sort of expense or expenditure would show up on the government accounts. Money's coming in, which are all tax revenues and what have you, minus expenditures. But if you can take those expenditures and put them into the capital column, then the overall deficit or surplus, remember those days? We haven't had surplus for years federally, would be lower. Whereas in reality, they need to spend money. There needs to be a source of money in order to pay for any expenditure, including tax expenditures. And so where do they get that from? Well, the bond markets, debt. And so all to say that I find this very, very misleading, and I just shake my head that Canadians will actually buy into this kind of garbage. It is very, very deceptive and very misleading. Let me read to you what the Parliamentary Budget Officer released yesterday, late yesterday, October 7th, as a result of this new stated capital budgeting method. It says, the PBO is pleased that the government is maintaining its existing financial reporting and is committed to remain fully compliant with public sector accounting standards. Okay. In other words, the government is not intending to change the definition of capital for purposes of financial statements, because if they did, that would go against public sector accounting standards and the definition that I just read to you earlier. So, but what they're doing is they're doing it not for financial statement reporting purposes, they're doing it for budgeting, which a lot of people will at least see, in the media will focus on the budgets. The media generally doesn't focus on the public sector financial statements that are published by the government. Number one, they're hard to understand. And number two, financial statements are typically not sexy, whereas budgets, revenues minus expenses, are much easier to understand. So that's the first paragraph. Second paragraph. Under the government's new capital budgeting framework, which I just read to you, capital investment is broadly defined as any government expense or tax expenditure that contributes to public or private sector capital formation held directly in the government's balance sheet or on that of a private sector entity, indigenous community, or another level of government. Okay, so it's just repeating what I just read to you earlier. Next paragraph. Finance Canada acknowledges the breadth of its definition and noted its intent to focus on spending classified as capital investments that would meet conditionality and identifiability criteria. Finance Canada also identifies 6 categories of federal government spending that would be classified, and I skipped that part because it's rather lengthy, but Finance Canada's definition and categories expand the scope of capital investment beyond the current treatment of capital spending in the public accounts of Canada, which is public sector accounting. Based on our initial assessment, we find that the scope is overly expansive and exceeds international practice such as that adopted by the United Kingdom. Specifically, the inclusion of corporate income tax expenditures, operating or production subsidies, and measures to grow the housing stock likely overstate the actual contribution of federal government spending to non-residential capital formation in the economy. That is, federal spending under these categories represents the fiscal cost of related measures and not necessarily the amount of non-residential capital formation that will be undertaken in the economy because of these measures. So I won't get, for purpose of this podcast, I won't get into the weeds of some of the stuff that he's talking, or that the PBO is talking about with respect to non-residential capital formation, but I encourage you to go and take a look at it. I just want to focus on the fact that the PBO said that it's overly broad and expands the scope unnecessarily. And I think the PBO is bang on. And so where does this all leave us? Well, this leaves us, and I'll be writing and speaking about this lots in the next few weeks because I find this so horribly deceptive. This leaves us where we have a government that is committed to try to minimize the transparency of its overall spending. And the PBO has already put out warnings in the last couple of weeks about, if we don't change course as a country in terms of its spending and getting our deficits under control, we could go over the fiscal cliff. And so I am quite concerned, and this is why I'm very upset and bothered by how a government could so purposely try to mask overall spending into something as lame as operating and capital for purpose of budgeting, when really all we care about and all bond markets care about is how much you're spending, how much do you want to borrow from us, and do you have the ability to repay this, and what's your overall interest costs. So my conclusion here is really spread the message that this is not a transparent way of doing government budgeting. It's quite frankly deceptive and offensive. And I'd be happy to challenge anyone to a debate. I saw one particular person recently, I'll keep them nameless because I don't feel like getting sued, but who basically says that, well, this is a great way to do budgeting. All governments should do this. Right. And don't get me wrong, categorizing things as capital and operating is classic accounting, right? To prepare a budget, to prepare a balance sheet. But when you're looking at cash flow, all we care about is, especially from the federal government context, all we care about is how much you're spending and how much you're bringing in. There's no upshot in separating the operating budget from the capital budget when really what you're concerned about is how much you're spending. And yes, for those that are out there that say, well, why wouldn't you budget? Yes, for purposes of budgeting capital and budgeting operating expenses, that can make some sense when you're running a business, because ultimately at the end of the day, you got to be very careful about how much you're spending and what kind of balance sheet you're growing. But in this context, in this very, very broad definition of capital that the government is intending to adopt for its new budgeting framework, there's no other way to describe it other than just simple deception, in my view. It's offensive, and it should be to you as well. So with that, thanks for listening. I'm always happy to receive feedback. Please reach out anytime. My contact information is readily available. Thanks. Bye now.